Hello, I'm Jake Weinstein on the Asset Allocation Research Team at Fidelity Investments. Today, I'd like to share with you a few insights from our team on the state of the economy and recent market developments. So let's get started by reviewing the third quarter of 2025 and then look at what's ahead. After a volatile first half of the year, global stock prices roared back in Q3, helped by a constructive expansionary backdrop. Strong corporate fundamentals and a rate cut by the Federal Reserve. Most equity categories were positive on the quarter, with U.S. small caps and emerging market equities leading the charge. U.S. large-cap growth stocks, particularly in the infotech and communication sectors, added to their year-to-date positive performance sparked by accelerating earnings momentum. These companies received a boost from business investment in AI, which continued its accelerating trend and provided a significant contribution to GDP growth. However, business investment in other sectors of the economy remained tepid. In addition to AI spending, the U.S. economy has been supported by a consumer who is older, wealthier, and more market-sensitive. Consumers enjoyed record-high exposure to equities throughout Q3 as the stock market hit all-time highs. Household strong balance sheets allowed for stable consumption spending despite softer labor conditions. The gains from wealth remained uneven, with high earners and older cohorts holding the majority share. And an aging population with concentrated wealth implies the economy may be more susceptible than in the past to swings in asset prices. Meanwhile, the global economy remains in expansion. Countries across the globe are in various phases of the business cycle, amid a variety of fiscal, monetary, and trade policy crosscurrents. The U.S. demonstrated a mix of cycle dynamics, including improving corporate profits and credit conditions, while other areas such as labor markets softened. China and Europe experienced signs of improved cyclical momentum, and many regions continued to ease monetary conditions. The unsettled global policy backdrop has encouraged countries to enact various policies to support domestic growth. But it wasn't all positive for the economy during Q3. Downside risk to employment increased as most of our indicators in our labor market dashboard softened. On the inflation front, tariff hikes likely contributed to the jump in manufacturing input costs as goods prices started to move upward for the first time in 3 years. After pausing for a year, the Federal Reserve cut its short-term policy rate by 25 basis points, citing that weaker labor markets outweighed the risk of above-target inflation. The market expects the Fed to continue rates into 2026, but given concerns over sticky inflation, elevated fiscal deficits, and political influence, longer-term interest rates could remain elevated and challenge the Fed's ability to influence the economy. Finally, fiscal policy is providing a cyclical boost but could create challenges down the road. Tax cuts in Q3 were likely to provide a modest cyclical lift to the economy and a pronounced boost to business cash flows and profits over the next 12 to 18 months. The legislation increases fiscal deficits over the next decade with an expectation of rising interest payments on the debt. And the challenging fiscal outlook is likely to influence longer-term interest rates in the coming years. When we put this all together, the U.S. and global economies are in expansion and the corporate sector appears healthy. However, sticky inflation, policy uncertainty, and elevated stock valuations present challenges to the outlook. So maintaining a well-diversified portfolio and focusing on long-term objectives are as important as ever. For more information on our perspectives and the current themes in the financial markets, please read our complete quarterly market update at fidelity.com/QMU. Thank you for watching this market update. We look forward to seeing you in the next one.